All right, welcome to my YouTube channel. So my name's Igor. I have paid literally millions of dollars in interest to private money lenders over the last 12 years running a real estate business. And I don't have anything to sell you in this video. I'm just gonna walk you through exactly how I underwrite and analyze and source hard money deals that come to me. So I'll take you step by step through the whole process, and then I'll also walk you through a full example of a deal I just funded on Friday that will include all the texts and emails with the borrower, analyzing the properties, and taking it all the way through the finish line with the attorney and the title company and everything. I'll show you all the communications and all the docs that come with that. So let's check it out. All right, cool. So here's the whole board that we're gonna walk through step by step. I'll show you guys kind of a quick teaser on the deal that I funded, what the terms look like. So here's the term sheet. So it was secured by 3 properties. The guy wanted to borrow $55,000. I was able to get $4,000 in fees up front. So that's almost like 8% in points, and then 14% interest. So getting $650 a month on my $55,000 loan. So I'm gonna walk you guys through the whole thing step by step. Cheers. So this is my company, Evolve Property Group. We raise capital from accredited investors and deploy it into various alternative strategies. So going step by step, how I underwrite loans that I'm doing in the debt fund. It all starts with deal flow. Most important, you can't underwrite anything if you don't have anyone sending you deals that they want to borrow money against. So it all starts with deal flow, but luckily there's a lot of demand for this kind of product between flippers, developers, rehabbers, landlords. There's actually a really big industry for private loans or hard money loans. So we know how to get in front of those borrowers. Like I mentioned, I've been a flipper / developer for over 10 years. And so through just being active in the market and maintaining a good reputation, that helps makes things pretty easy. But I'll go through step by step every single way that we generate leads. So let's get into that. Obviously, like I mentioned, kind of omnipresence and just people in the market knowing me and knowing who we are as being active investors. So, like title company referrals. This is my title agent. She'll connect me with people regularly and send people my way that are looking for financing. So here's a couple of different examples and screenshots of that happening. See, Vince is a wholesaler. Bert might know him. He has a customer who's looking for a short-term $25K to complete a rehab. Right, so title agents, contractors, investors might reach out to us looking for funding. So the second way that I generate leads for this business is through using public records to scrape and source, basically find other active investors that might not know me or might not know to reach out to me about getting funding for their projects. So I leverage large data sets and machine learning to find, scrape, and reach out to likely qualified borrower clients. So what that looks like is maybe going into the public records and pulling out LLCs and corporate buyers that have purchased properties recently. Might reverse engineer those entities that have had a mortgage recorded from other entities that we know are lenders. So for example, in Chicago, a big lender is Renovo, and their entity is like RFLF. So you can go into, for example, here, the local county recorder's office and search, do an advanced search for grantor grantee and put RFLF and do document type mortgage. Right, and here you could see loans that RFLF is making to all these borrowers. So you go in here, there's over 1,000 records, and you take all of these are borrowers that are borrowing hard money in this market right now. Right, so you can go literally copy and paste this into a Google Sheet and then have a Fiverr or Upwork virtual assistant go into the county records and find you the managers of each of these LLCs. So you could reach out to them directly or send them a letter or, however you'd like to reach out to them. So that's kind of a quick trick on how you could do that. Similarly with corporate / LLC buyers, you'd go into your local county recorder. Instead of putting mortgage, you might put deed and put properties. Okay. So Anthony Investment Properties, North Riverside Investors, blah, blah, blah. Same thing. So these are all obviously real estate investment companies, and you could reach out to, copy and paste, do the same thing, and reach out to these people offering your services as a hard money lender. You could look at listed and or sold flip properties on the MLS. So you can go on the MLS or you can go on Redfin. I'm just going to quickly show you guys this. This isn't like a full crash course in how to generate leads. I can go more into that and make a separate video about it. But you could just go here, keyword search renovated or rehabbed. And then now you have, there's 21 homes in this zip code that have been rehabbed by an investor. So you could go into the county records and search this address and reach out to the investor directly, or you could see the listing agent here. I actually know this guy. So then you can reach out to the listing agent and say, hey, I see you represented this client on Parnell. What are they doing for financing? I'm a private money lender. I would love to be on your contacts as someone who offers hard money to your investor clients. And then that way, that agent could be a repeat source of business through, various different borrowers that they might work with. And then this is kind of a little bit more of an aggressive one, but corporate owners with financial pressure, back taxes, delinquent, vacant property, etc. So using a similar website like the county court website, you could find cases for, let's say, tax delinquents or code violations or things like that. And then similar to the things I showed before, you could search properties or LLC or investors or, any combination of those things to find investors or LLCs that are in any one of these like distress kind of cases and offer them, bridge lending if they need it. So those are just a couple different ways that I just wanted to show you a quick and dirty example of how you can start your omnipresence and start being known as a lender in the market by sending out this really tactical kind of guerrilla marketing to qualified borrowers. So we send out letters primarily to these people, and it's just automated, and then they'll call back in through our answering service, which I use signmore.com. This is $385 a month, and then basically anytime someone calls the phone number on your letter, they go to a professional answering service that sounds like it's a receptionist at your front desk. So they could say, hi, this is John Doe's Private Loans. How can I help you? Or hi, this is Sandy with John Doe's Loans. How can I help you? And you can give them a script of like what information to collect on those calls. So I don't have the full web forms here of how that looks like, but you might want to collect a property address, a desired loan amount, and how many deals the borrower's done, and how quick they're looking to close. And then you'll just get an email from SignMore with each one of those leads, and you can follow up with the ones that you want to follow up with. So that's a really good way to start getting your first few loans done and start building that omnipresence and that referral channel, and those referral channels rather. So that brings me to my next thing, realtors and mortgage brokers. This is another way. And these really are more bang for your buck because, you could search like investor, realtor, or mortgage broker with your zip code or your city on Google and find those totally for free without having to dig through county records. And then a lot of times these brokers turn into repeat, kind of clients, because if you reach out to one borrower directly that does 2 flips per year, you might be able to do 2 loans per year with them. If you reach out to a realtor that specializes in working with rehabbers, they might have 20 clients and each of those clients do 2 deals a year. So you have 40 opportunities instead of 2 there for one phone call. So, and realtors and mortgage brokers like to have a private lender kind of on speed dial and someone that they can count on because it's a big value for their clients too. If they're like, hey, I'm a realtor, I want to win your business, I could help you with funding, I can help you with this, with that, X, Y, and Z. You make them look better and ultimately can benefit you as well. So this is a loan broker that we did a loan with, and he's sending over different ones, additional deals. This was another guy that they do private hard money, something loan solutions, and they'll, when they have clients that can't meet their other lending programs or whatever, they could reach out to you with those leads and see if you'd be able to help. And some other stuff that we do, this might not be for like a beginner person that's just getting off the ground, but if you're growing a real like hard money lending business and you might set up a website and start running some ads, we have some cool stuff on ours, like calculators where people can go in and punch in their numbers and get their estimated profits and get rough terms just right away on the calculator without having to speak with anybody. So this is like a really easy tool to develop, the calculator. But we had that built out, and it tells the borrower they can come in here and punch in their stuff, and it says how much down payment they need to bring, how much they'll pay in fees, how much they'll pay in other closing costs, how much cash they need to close, how much they'll pay in interest over the duration of their project. So just different borrower-friendly tools and resources that could provide value to your potential clients and that you could advertise. If you have this cool calculator, you could post it on your Facebook or Instagram or do ads or whatever the case might be. So all of those leads that come in from these different channels eventually turn into deals, and those deals turn into satisfied borrowers, and satisfied borrowers turn into repeat business and referrals, which ultimately turns into more leads and helps build your omnipresence. So that's kind of just a little bit on how I generate business and how I attract borrowers, and some things that you could copy and apply in your own business. Brings us to the next step. Once you have leads coming in through your Sign More or through people reaching out to you, they're going to have to fill out an application. So this is what the application looks like. I can actually give you guys, I'm going to link it in the description. I have a fillable template for this exact application that you can just download and use for yourself if you'd like. Basically, we collect all types of information about the borrower, their experience, and their deal. So that includes their social, so we could pull a background check and or a soft credit pull, standard as a lender to pull that if you would like. Here it goes into, collects more information about them, their employer, their business. Here it describes the project, so it could help you understand if they've done this before. Experience is very important, especially if you're newer or not super experienced in real estate. You want to know that they're going to see this project through to fruition, and not so you don't have to foreclose and finish it yourself. So the experience is crucial. A lot of lenders won't lend to someone on their first deal, and that's for good reason. So something to think about. Here shows you more about the experience, how many times they've done it, and you can look up these addresses and see the level of finishes they did and how long it took them to do those projects. Here it shows how their net worth looks. When you're a private lender and doing loans like this, you're almost always getting a personal guarantee. So this helps you understand if their personal guarantee is actually worth anything. If they have them $500,000 in the bank account, a bunch of properties, a nice car, and all kinds of stuff, they're going to be more likely to pay you, especially knowing that it's personally guaranteed. If they have no assets and a bunch of credit cards, that personal guarantee is not worth as much because they're already close to bankruptcy as it is. So the only way a personal guarantee gets wiped off is if the borrower files bankruptcy. So this protects you if, the deal blows up and they could just abandon their LLC or something. The personal guarantee helps protect against that. This is any real estate that they currently own. You can get a better picture of their whole portfolio and the amount of leverage against all their properties. How does their monthly cash flow look if they have a job or other sources of income? So it can give you an indicator of how much breathing room they have. If they only make $2,000 a month at part-time at Wendy's and the payment on your loan's $4,500, if things take longer or go over budget, they're going to be more likely to default than someone that has, that's making $30,000 a month in dividends from some REITs that they own or something. And then their spouse makes $20,000 a month as a dentist. That person's going to be less likely to default. Okay, and then the last page, they're just disclosing if they're litigious or if they're criminal, if they have a background. If someone's been sued for fraud 3 times, you might not want to lend to them. If they filed bankruptcy 2 times, you might not want to lend to them. So these questions help paint that picture for you. So the application helps provide you with all the pertinent information that you need to make a decision. Now, next comes the most important step and the real crux of a successful deal, and that's underwriting, which is what the bulk of this video is going to be about. So for my debt fund and for the deals that I look at, and this might be slightly different for you, but in most cases, these are asset-based loans. You're not lending based on the person's creditworthiness or their net worth or things like that, or their income like a traditional mortgage. Hard money loans are asset-based. So although you can use all those other factors as little pieces of your decision making, our North Star is the collateral. If the underlying asset is good, meaning it has significant equity above and beyond the requested loan amount, only then can we move forward to analyzing the other factors. Personally, me having a lot of experience as an owner, I don't care if the guy's in default on his current mortgage, he's got maxed out credit cards, no money, whatever. As long as he's trying to borrow $100,000 on a $500,000 property, that loan's pretty safe because I'm not scared to take that property back. In that case, I'd probably even wish that he would default. So, if on the other hand, you're very conservative, you want the monthly stable income from your private loans and you don't want to take anything back, you might be put more weight on some of those other factors. But at the end of the day, the collateral is what protects you, and having that loan to value be at a safe spot is what's absolutely critical in successful hard money loans. So to determine the equity, there are 3 main ways that lenders look at this. There's loan to value on the as-is value of the property. So ratio of the loan amount to the property's current market value, meaning if the property's in bad condition, needs rehab, you're going to look at comps for other properties that are in bad condition and need rehab and see what those are selling for. And the formula you'll use is your loan amount divided by purchase price or current appraisal times 100. And the use case for this will be initial purchases or bridge funding where you're not doing rehab draws and stuff like that. So that's an important number because if you're lending $150,000 up front and they're buying for 100 and it's worth 100, even if it's worth 250 or 300 when it's done, if they disappear, then you lent 150 on a $100,000 property and you're upside down. So you need to be smart and methodical about the schedule in which you release funds to ensure that the amount of money that you have out on the property is never higher than the property's as-is value. Number 2, this is the probably most common thing that people look at in this industry, and it's the ratio of the loan amount to the after repair value. So like in that example I just gave, it's the $150,000 loan over the $350,000 finished value. So the standard there is about 75% usually. You'd never want to exceed your total loan amount being 75% of the finished value. On loan to value on as is, maybe you'd go up to 80% or 85%, just enough to recover your money if it went bad. So you're still below the as is value and have a buffer there for foreclosure costs and attorneys and carrying the property while that case, the foreclosure case, works its way through the system, but you don't need as much cushion there. The reason you need more cushion on the ARV is because, again, if it's done and you lent 75% on the fixed up value, if they do abandon it at that point, the fixed up value is going to go down because unless you're coming in and maintaining the property, it's going to get overgrown, it might flood, it might get torn up. So you need some more buffer there. And then the third main thing that people look at is loan to cost. So this is your indicator of how much skin in the game your borrower has. So this is the ratio of the loan to the total project budget. So again, in the example, that $150,000 loan with $350,000 after repair value, let's say they're total cost is $200,000, you're agreeing to lend $150,000. That means that you want them to have at least 25% cash down payment into the property, because they're putting in 50, you're putting in 150 of the total project, and that's a total of 200,000 cost. So some lenders will go up to like 95% on this or 100%, and it depends, which we'll go into some examples here. It depends on the situation and on the borrower. But if you're a very conservative lender and you never want to exceed a 70% loan to cost and 50% loan to value on the rehabbed value, that's definitely possible. There's a lot of people out there that need bridge lending that don't need 100% leverage. They might already own the property. They might, whatever the case might be, maybe they've owned it for 20 years. There's just some deferred maintenance and they need to pull out a little bit to pay some bills and make some upgrades to the property. So you could totally run a business where it's like you're strictly doing stuff where there's 30% plus margin for error at all times. So for myself personally, we don't like to exceed 70% of as-is value. We don't like to exceed 70% of ARV and stay below 80% loan to cost in most cases. This is like the standard cut and dry kind of framework that I like to go with. So let's go into a real example number one. This is actually the one that I just funded on Friday, and this is a perfect example of somebody that owns multiple properties. They basically bought, these two are vacant lots that are next to each other. They paid $60,000 for those two, and then this is a house that they paid $60,000 for. So they own these properties free and clear. The guy just needed to pull out some cash because he was buying another vacant lot and he wanted to pay for some other expenses, and all he needed was about 50 grand. So we agreed to a loan of $55,000 for 6 months. And yeah, in this example, they got plans and permits for the house as well. So their cost is at like $135,000. And the as-is value is even greater than $135,000. We provided them a loan of $55,000, which is a loan to cost of loan to cost of 40.7%. Obviously, that's very safe because it's secured by 3 properties. Those properties are worth considerably more than the loan that we're extending. And if the borrower defaulted and we had to foreclose, then we would do amazing because we would charge default interest. It would take 6 months or a year to move through the foreclosure, and we would certainly get paid back in full at the foreclosure auction because someone would bid very much in excess of $55,000, which would cover all of our costs and fees and interest and everything. So those are great. We love those. Now let's go to example number 2. This was a house that this guy was going to rehab. So he was buying it and needing rehab funds. So it was a loan amount total of $160,000, wanted to fund $110,000 at closing and a $15,000 rehab draw already starting right off the bat. So, and the $35,000 of the total $160,000 would be held by the lender and advanced to the borrower as the rehab progresses. These were the terms and the fees. So the borrower in this case bought the property for $105,000 and it was worth about $105,000 as is. The total loan amount was $150,000 and we funded $115,000 at closing. So this is an extreme case where we funded higher than the as is value and higher than the borrower's cost on day one. His cost was $105,000. He got $115,000 day one. But this was only because it was a very experienced repeat borrower. We've done multiple loans with this borrower, personal guarantee, all that good stuff. This is much riskier, but we did extend those terms and do that deal. The ARV was $230,000, so the total loan was still under 65% of ARV, and what we funded at closing, the $115,000, was 50% of the after repair value, but there was that risk for the first month. Had he disappeared when we had the $115,000 out on a $105,000 house, we're upside down. So some risk there in a deal like that. So let's go into, I guess kind of wrapping up the thought on that one. It's all based on the asset, like the example with the 3 properties. There could be almost any other, issues or red flags about the borrower outside of fraud, obviously, that we would be okay with because of how low that loan to value is. Whereas on the second example, there were some secondary considerations like the borrower's experience and the value of their personal guarantee and their previous performance that we needed to consider in order to approve that because it was higher than our normal loan to cost requirements. So, like I said, those secondary considerations can be experience, their credit score, obviously shows an indication of their financial responsibility, their liquidity. If they have a lot of cash on hand, you might be willing to advance or go higher on loan to value. Their exit strategy, the location of the property, if it's in a more ghetto area or where it's more likely to get broken into or stuff to go wrong, you might want to be safer. If it's in a high-end area, maybe you can go a little bit higher on your loan to value. So ultimately, we look at any combination of these secondary factors, the equity in the asset, the potential for additional collateral, and we make our decision on approval or denial at that point. All right, cool. Let's go on to the next step. So obviously, if you deny that loan, you simply say to the borrower, hey, I can't do this loan because of these reasons, or hey, I can do this loan, but you need to give me this much more cash down, or hey, I can do this loan, but I need some extra collateral. Do you have any other properties? So if you ultimately end up approving the loan based on them being able to meet those additional conditions, then you send the borrower a term sheet. And what that looks like is like this. And I'll share the Google Drive with the term sheet template as well in the bio, in the description. So all that a term sheet does is basically spell out all of the terms and conditions of the loan. So the borrower name, who's the personal guarantee going to be, the lender's entity, the properties that are to be collateral, meaning that your note is going to be recorded, or that your mortgage is going to be recorded against, or your deed of trust, depending what kind of state you're in. This is the duration, 6 months. Collateral is the 3 parcels. The loan amount, the term of the loan, the interest rate, how much you're charging in origination fees as the lender. You could include a purpose. So if it's purchase and rehab, or it's a cash out refinance, or whatever the case might be. The interest rate and what the amount of the monthly payments will be. The availability and maturity of the funds. So how much you're funding at closing. The entire loan amount will be funded at closing and released to borrower. If you're doing rehab draws, then it might be, $35,000 is to be released at closing, and the remainder will be dispersed to borrower with $10,000 rehab draws upon completion of scope of work items. And then repayment, you spell out how the loan is to be repaid. Monthly interest only payments are due on the 1st of each month, paid in arrears, meaning January interest is due on February 1st, etc. Principal balance will be due as soon as a balloon payment exactly 6 months after the date of funding the loan. And then spelling out again the fees. This is the fees that went to me as the lender, and these are the fees that are paid to the attorney for preparing closing docs. In my term sheet template, it spells out exactly what the loan package is going to include that the borrower has to sign: escrow instructions, promissory note, mortgage, personal guarantee, balloon payment disclosure, use of proceeds declaration, etc., etc. This is all kind of prepared by the attorney. So if you're doing your first couple of loans, you can speak with attorneys in your local market and say, hey, what kind of documentation is normally included in a loan package for a private money loan? So you sign it as the lender, your borrowers sign it. Oh, here it's spell out again what it all includes. And you can write whatever you want on here. If you want the borrower to take you out to dinner 2 times per month, you could put that in the term sheet and include that in the loan docs if you want. But this is a standard, set of instructions that's provided to both the borrower and then the lender, and then the attorney to spell out the terms of your deal. All right. After the term sheet is executed by all the parties, we can move forward towards the closing. So speaking about term sheet and just going back one sec for all of these documents, I am currently annotating an entire loan package. It's like 50 pages for all of these different documents combined. So I'm going through it right now actually and just blacking out like private information, but I'm putting a description on every single paragraph and what it means. So I'm going to make another video walking through the entire loan package in detail. That's not ready yet, but that'll drop this week. So subscribe if you guys want to see that. But what happens after that term sheet's executed is the borrower, because they'll have a purchase contract on the property, or they'll have the deed if they already own it, they'll order title at, you can choose the title company or they can choose it, and they'll order title there. So what that is, a title search to make sure there's no other encumbrances or liens against the property, make sure there's no other exceptions. So to make sure that you're getting clear title and you're protected, the lender sends in the term sheet to the title company and to the lender's attorney. So the lender's attorney is paid for by the borrower at closing. As the lender, you don't have to pay the attorney up front. And the attorney will prepare all of these loan documents for you. Again, paid for by the borrower. So then the lender and the attorney ensure that all the conditions are met. So all the conditions from your term sheet and anything that you might have missed, the attorney will walk through that with you, and you'll have to communicate throughout the process, make sure all those conditions are met. Once the documents are signed, the closing is happening, the attorney and lender will get the whole loan package sent to them by the closer, and we'll have to confirm that all the documents are there, the borrower's insurance is in place, all of your requirements are met, and then the lender, being you, would authorize funding and say, okay, we're good to fund. They can complete the closing, and then the title company will send you a check or a wire for all of your points/fees, and it could be prepaid interest for the rest of the month, however you like to do it. Then that's basically it. I'm not going to go into much more detail beyond that on the specifics of the closing process. I'll talk a little bit more about it right now in the example, show you some of the email conversation of how that goes. But we could do maybe another video breakdown like this of like just an entire email chain of a closing and see, because sometimes issues do come up. Like the title agent might ask questions about a certain thing on title, and you'll have to talk with the attorney and go back and forth and clarify things and work with the borrower. And, it's never like perfectly smooth, but, having the term sheet in place and having a good attorney that kind of watches your back, helps make sure you get through the process pretty smoothly. And best part about all of this is, even if you miss something or you mess this up, you have insurance. The borrower is paying for title insurance to make sure that your lien is protected. Even if the title agent messed something up, even if your attorney messed something up, they all have insurance for things like that. At the end of the day, it's their job to make sure that your loan is secured by this property, free of any other encumbrances. And if anyone messed that up along the process and you didn't catch it, you go back after those people, because it's their job to do that, not yours. So you're protected, but it is good to be aware and familiar with the process as you're going through it to try to avoid issues. All right, let's get into the real deal example. So like I said, this is a deal that I just funded on Friday, yesterday. So let's walk through it step by step. So this came in initially from a text message. This is a guy that I know that I've worked with before. He's a developer, and he initially reached out to me about, I'm closing on a lot tomorrow for 15 grand from Land Bank. Can you give me a bridge for 25 to 30 to cover land and architect? I'm selling this other property, so I know I could pay it off. I said, would you be down to cross-collateralize with any other property initially, because it's such a low value purchase. Like if it's worth 30 grand, even if I get a loan for 20, I'm at 66% loan to cost, but that 10 grand is not very much margin for error because of the low loan amount. So he said, sure. I said, what's the address? He had some collateral, but there was already a loan on it. I'd be in second position, so not ideal. He sent me some information on it, and that included his contract. So I looked at his contract, and because he's buying it from the land bank, which is like a quasi-government kind of seller, they have this additional stipulation where it's basically a $20,000 penalty. He's paying $11,000 for the lot, but if he were to just flip it quick, which the land bank doesn't want, they want you to actually develop it, then he would have been paying $31,000. And how they secure their interest is they record a $20,000 loan that's released when he ultimately redevelops the property. So that's intended to deter wholesalers, and it would most likely get taken off, but that would put us in second position off the bat on a property that's worth $30,000. It already has a $20,000 loan on it. So there's no way that I could lend on that. Basically, like, well, I'm going to give him a $60,000 loan so he can get 30 out, and I'll be in at 2x the value. That's not going to work. So it was basically a non-starter, but wait, he said, call me when you have a minute. They also have 2 lots with no loans. So that's good. He had some more collateral. And these were the 2 properties. He paid $60,000 for one, $60,000 for the other. So he had a double lot and another house they had free and clear that we could leverage. He paid $60,000 for each of those, and he invested that extra $15,000 into plans and permits for the house. So that put us at $120,000 cost. I said, hey, we can do $45,000 for the lots in the house. Payment $550, $3,500 in points. This was kind of just quick terms. After he did the application, I purposefully asked, do you need 6 or 12? Hoping that answer 6, because then I could charge a fee to renew at month 6. So he ultimately responded that he wants a little bit more. He wanted 55. So this is the term sheet you saw earlier where we agreed to 55 because that's still a very comfortable number. I wanted to get $650 a month on this and $4,000 in points. Percentage-wise, that's like 8 points. That's pretty high. You're normally charging like 2, 3, 4 points, but because it's a low loan amount, you could charge a flat fee in those cases. So once he executed the term sheet, we sent it to the attorney to craft the docs. Literally just send him that 2-page term sheet, and then the attorney flips you back 50 pages of completed loan documents. You can review those. You don't really look at it line by line. Like I said, I'm going to make a video breaking it down line by line, but usually you're just looking to make sure the amounts and the names and all of that are correct. And again, ultimately the attorney's on the hook and responsible for making sure that that's all correct. So then from there, this is already the attorney sending this in. There's an email chain with the title company, and they go back and forth about some tax exceptions, some endorsements, etc. And once the borrower went in and signed the loan documents and the closing documents, the title agent has included the complete signed lender package for the lender and attorney to approve to authorize disbursement of the funds. So we agreed to disperse the funds after we reviewed the numbers and that the documents were completed correctly. And as you see here at closing, they take the money right out of the $55,000. So get my $4,000 in points right away, get interest for the rest of February here. So his first payment will be due on April 1st for March interest, because this is February, say 15th through the 30th. So he prepays that interest. Then he won't have a payment on March 1st because February interest is already paid. And then April 1st, he'll have his first payment for all of March interest. And then the attorney got their document prep fees. So that's pretty much it. Pretty simple. There was some more back and forth between the attorney and the title agent on this, just nailing down making sure that title's clear and everyone's protected. But ultimately, it's that simple. I probably spent maybe 30 minutes to an hour just texting the borrower a few times and talking with him on the phone. And now I get $650 a month for the next 6 months, and I've already made $4,000 back. So really, I'm getting $650 a month on my $51,000 investment. And that is how you make money as a private lender in real estate. So drop any comments if you have questions or what you'd like to see next. The next video about this I'm going to drop is like going through that 50-page loan package line by line and explaining that all to you guys. And other than that, let me know anything else you want to see. Subscribe for more, and I'll see you guys later.